Big news, interest rates just dropped to their lowest point in 3 years, and if you've been waiting for affordability to improve, this could be your window of opportunity. Today I'm breaking down what this means for you as a home buyer or a seller, and what's driving the shift, and how to read the market signals that most people overlook. Let's start with what just happened. Mortgage rates have fallen to the lowest level that we've seen in 3 years. Now most people assume rates move directly with the Fed, but that's not actually the case. The Federal Reserve sets short-term rates and not mortgage rates. Mortgage rates are much more closely tied to the 10-year Treasury yield, which has been hovering around 4% and trending downward. When the 10-year yield drops, mortgage rates almost always follow. That's exactly what we're seeing right now. So why does all this matter? Well, because of affordability. One of the biggest barriers for home buyers right now is tied to three things: home prices, mortgage rates, and wages. Prices have remained relatively flat over the last year, and wages have actually grown faster than mortgage cost. And now mortgage rates are starting to finally come down, so put all that together, affordability is finally improving in the right direction for the first time in years. So to put this into perspective, just a 1% drop in mortgage rates can increase a buyer's purchasing power by about 11%. That means that the same monthly payment now gets you a noticeably nicer home or helps more buyers qualify for the home they really want. So what's behind all this shift? Well, the Federal Reserve is expected to cut rates 2 more times this year, each by about 0.25%. While those cuts don't directly lower mortgage rates, they do signal to the market that inflation is starting to cool and that the Fed is confident that the economy is stabilizing. That sentiment helps push bond yields lower, and as we mentioned earlier, when those yields drop, mortgage rates follow as well. We're already starting to see this play out in real time. So what does all this mean for you? Well, if you're a buyer, lower rates mean lower monthly payments and potentially the best affordability window that we've seen in several years. And if you're a seller, that means more buyers can now afford to get back into the market and potentially put an offer in on your home. So increased demand tends to stabilize home prices, and in some areas can even start to push them up again. In other words, affordability today could help bring opportunity tomorrow. One last thing to watch is the spread between the 10-year Treasury yield and the 30-year mortgage rate. Right now, that spread sits around 2.16 to 2.3%, down from over 3% recently, but still a bit higher than the normal range, which is like 1 to 2%. So if that gap continues to narrow and go below 2%, and the 10-year yield stays near or below 4%, we could actually see mortgage rates fall even further into 2026. But if inflation starts to tick back up, that trend could stall. So keep an eye on that 10-year Treasury yield. It's one of the best forward indicators in real estate. So if you've been sitting on the sidelines waiting for that right time to buy, this might be it. With rates at a 3-year low and affordability improving, it's worth taking a fresh look at your numbers. Our team can help you compare your options and run numbers to see if now's the right time for your family, because remember, who you hire matters.